Money Vikings, welcome back. I hope you're having a great Memorial Day weekend and definitely want to honor the troops, honor those who have fallen, honor those who serve. Uh, Very critical. And without that, we wouldn't have these opportunities to invest and build wealth. But with that, there's been a lot of talk lately about, again, more and more recession talk. And again, we've been talking about this for a long time. We've had many strategies on truewealth.moneyvikings.com on how to deal with and to invest through a recession. In fact, recessions can typically be some of your greatest investment opportunities. At least that's been our experience over the last 25 years of investing, is that when the market has been completely freaked out and scared, has been a time to quite simply buy assets on sale. But we're in kind of a weird place right now. Some things in the economy seem to be doing well. Other things do not seem to be doing well. I think we're all feeling the pain of inflation and all that. And I started thinking, what am I really doing right now? And that's what I wanted to talk about in this episode. And so again, thank you for watching, listening, reading, etc. You can always find more at truewealth.moneyvikings.com. But please follow and like us on YouTube as well, again, for everything building wealth, health, collecting, and more. Let's get into it. A Viking bear market strategy for the raging 20s. So the raging 20s is our concept that we've come up with for how to invest through the 2020s. And I think we can all agree that it's been a interesting and turbulent time on many fronts. So kind of got off to the start with a pandemic. And I think the turbulence will continue. There'll continue to be turbulence. But we can't just lose the decade. We need to find places to invest and build wealth, and probably more importantly at the moment, also to protect and to minimize losses. That's something I want to emphasize in this video. Minimizing your losses is sometimes just as important as what you do to make gains in investing. And obviously this has been summed up with Warren Buffett's famous quote about the rule number one of investing is not to lose money, and rule number two is to not forget about rule number one. So to me, that's about risk management. And it's not putting all your eggs in one basket. It's not always going in on the next hype, high risk thing. And it's being very prudent and practical about how you build your portfolio. Have some cash reserves. Find some diversified ETFs. Find places where you want to park money in bonds and collect an interest rate. Strategically pick real estate investment trusts and dividend paying stocks. Again, over time, you're building, you're compounding, all that. So let's get into a couple concepts here. Okay, so it's a simple approach in a chaotic world. Be the bear market investment god. So the Norse gods, Thor and Odin, often took the shape of a bear to visit the human world. And the bear stood for strength, healing, inner wisdom, and balance. So that's what we're looking for with this kind of portfolio, this kind of approach. We're looking for wisdom. We're looking for strength. Okay, I'm doing a play on words here. I know it's a little bit of a joke because a bear market is when the market's going down. But again, I want to emphasize it's not always a bad thing in the long run. Number one, you're building a portfolio not to have a magical day where you just cash everything out and it's all in cash and you just take it all. The idea is to create a passive income machine where you can draw income off of that investment account over many, many years without it depleting. So month to month, it really doesn't matter what the fluctuations are. Yeah, no one likes opening a 401k or an investment account and seeing that one month it's 200,000 or 100,000 and the next month it's 100,000 or 50,000. It's been cut in half. That's a very hard pill to swallow, is it not? Now, if you can imagine that, and that would really, really upset you, then that is you on your journey to understanding your risk tolerance. So that is a key thing to hone in on. And if your risk tolerance is zero, there is no such thing as zero risk, because even an all cash portfolio is losing 7% a year in inflation costs. So an all cash portfolio is not zero risk. It's in fact a 7% downgrade every single year for a long time until we get inflation down. I know inflation seems to be down to something like 4%. The Federal Reserve wants to get it to 2%. We'll see. They're going to keep working. They have their work cut out for them, of course. Do check out the Antagonist. I have a link here. That's another blogger, Jason. Does a great job. Love his newsletter. Check that out. I talk here about the raging 20s. That's our theory about the 20s, and it's going to be an interesting decade. And it's a lot about managing risk and being strategic. So the back to basics approach for a bear market is number one, asset allocation. Okay. And again, I believe so strongly in this. I believe in a combination, depending on you and your particular risk. This is not investment advice. Nothing we say ever is. This is what I'm doing. But for me, there's a certain amount of investment risk I'm willing to take with stocks and equities. For me, that is around, I'll put it out there. For me, that's around 30 to 40% overall. Sometimes higher if I'm feeling like the market's really on a tear. But overall, usually around 30 to 40, maybe, low 40s. Okay. So heavy equities. Bonds, I see a place for bonds. Bonds are a lending instrument. You're lending money to a municipality or to a company in order for them to pay you back an interest rate, and at the end of the maturity, your principal. Okay, so it's a lending instrument, whereas an asset, as like a stock, is you have an ownership stake. You have a small ownership stake in that company or in the overall market of companies in the U.S. stock market. Okay, so I think there's a place for bonds. For me, personally, sometimes it's around 20%, generally speaking. Okay, and again, it's pulling off some income. It mitigates the real crazy downdrafts that we might feel, etc. And I usually like high-rated bonds, triple B or above, and I like a diversified collection of them. I don't like individual ones as much, but those are good too at times. Cash. Cash is probably pretty critical these days. There used to be a saying by Dalio that cash is trash. That's clearly no longer applicable. I think for a couple of reasons. Number one, we don't know what's going to happen with the market, and it seems pretty tenuous, and the economy. It seems like anything could happen. So probably good to have some cash on the sidelines. I like about 20% for me personally. Cash also offers opportunities. So when the market drops and you think it's a good time and you think assets are pretty well valued or lower than their fair market value, then cash can be deployed, as they say. You don't have to do it all at once, but you could take 5% of it and put that into a stock index that you think's been beaten up, but has long-term prospects. Okay. There is a place for alternative assets for some of us, gold, crypto. I also say alternative strategies, options trading, and all that kind of stuff. And some people do really well with that. Check out Jerry for a lot of options trading strategies. He uses great options trading strategies to, again, eke out a gain and make some income every year. And the last one I'll talk about are some hard assets. These are things to me like real estate, art and collectibles, wine. Probably not fair to put all those things in the same category. I mean, real estate is probably the classic one. Hard asset, you can do something with it, right? Okay, so we get that. So this is the time to dollar cost average. Okay, again, I always want to emphasize that we are not in a situation where we are going to cash everything out. We want a dollar cost average as the market has its problems. And that means you're buying shares of the market at a lower cost, okay? And the other thing is automation. Key time for automation. I think we kind of touched on this up above, diversifying strategically, but that's another thing I really like to do during a bear market. And sometimes there's places for commodities, a commodities fund to try to, again, mitigate. What you're trying to do is sometimes like level out the big drops. So you're not hitting a 25% drop. If you're diversified strategically, okay, the market, everything goes down and your portfolio takes a 7% drop. Well, it's a lot better than a 25% or 30 or 40, right? Okay, the second thing is think about the long term. Again, I will emphasize, we're trying to build passive income machines. There's not a magical day where you just say, I'm out and I'm done. That's the way I look at it. So think about the long term. You've got to keep expenses low. Expenses notoriously eat up. 1% is too much, okay? So there's so much better places out there now. There's so many low-cost abilities to have access to investment vehicles. So keep those expenses low. Don't forget about compounding. Check out our investing trifecta concept, okay? The compounding needs time. That's the key. It needs time. Number 7, think about it and get your mind straight for market volatility and use risk management. There's going to be market volatility. And finally, I'll end on this one. Investing is not gambling. It's not. You have either an ownership stake in a company or in the broad market, or you're lending money to something. That is very different than going to a casino where you're probably going to lose 99.9% of the time. Investing is not gambling. It's strategically using your assets to grow your wealth. I hope this helps. Everybody take care. Please like and subscribe. Thanks for watching and listening.